Good afternoon, ladies and gentlemen. Welcome to our special episode on Market Guru, where you get to meet the finest brains that are there on Dalal Street, people and professionals who've made money and lots of money in all sorts of markets, whether they are bulls, bears, momentums, or of course value buying. Our guest today is a gentleman who spent 33 years overseas as well as on Dalal Street, working with companies such as Merrill Lynch, CLSA, Jardine Fleming, Goldman Sachs, and of course some local brokers as well. Ladies and gentlemen, please welcome Mr. Gautam Trivedi, the co-founder and managing partner of Nepean Capital LLP. Namaste Gautam ji, a very warm welcome to you, sir. And what a day to get you on the show. 13 consecutive sessions of dark green on Dalal Street, and it's getting better and better. Is this time to book out of the party, or has the party just started?
No, I think the party hasn't started, and a lot of people who've been in the industry like me for a long time are wondering when will this party actually end. And I don't see that ending anytime soon, because if you look at the domestic mutual fund flows for the last 42 months consecutively, it's been a positive number from retail investors of money coming into domestic mutual funds. And we're looking at almost about $38 billion of year-to-date inflows into mutual funds, which is a record high. So I don't see this party ending at any point until we see a significant slowdown in domestic flows.
Fair point. And at 25,000 on the Nifty, I'm sure you would have remembered the first month when Nifty had started somewhere in 1995. We are at the silver jubilee of this index. When you look at the next 3 or 4 years, do you see this momentum continuing that we have on equities, or should there be maybe a 10-12% correction so that newer friends can get in and older friends can book some profit and maybe enjoy the money?
Sure. I think the way the financialization of the equity markets is happening, the pace at which it's happening, you're seeing incrementally almost 80 to 90% of the incremental new registered investors are coming from tier 2, tier 3, and tier 4 towns. So I guess the risk there is that a lot of these people are new to the equity markets, haven't ever seen a correction in their lives. And the concern I would have is, and as should the government, I think, have, is that if they don't end up having a decent experience, I mean, there has to be a correction at some point. Things can't go up one way upwards forever. But when that correction does come, it's not so brutal that they actually end up losing a lot of money or their life savings. So I think my view is that the pace of flows is still not slowing down. But I just hope a lot of these investors know what they're doing. They're entering the market at extremely high valuations, unless, of course, they are looking at FY 27 or 28 in terms of estimates, which is the only point where you actually find this market reasonably attractive in terms of putting new money to work.
Okay, FY 27 is where the current PE should be justifying those kind of earnings.
Exactly.
Mr. Trivedi, let's just drill down to how sectors are performing at the moment. You manage somewhere like 5,500 crore rupees, both in publicly listed stocks as also in the private space. Now, when fresh money is coming into Nepean Capital, what are the hunting grounds that you and your research team are looking at? Where is current money being deployed?
Yeah, so we are a special situations fund. So in some sense, we look for the incremental change that's going to happen in a company. And the changes could be any one of the following: change in CEO, change in ownership, generational change at a company level if the company is doing an M&A activity or selling a major asset or demerger of a business. And the fifth one being any change in government policy that could incrementally be positive. So we look for these sort of parameters. At the same time, of course, if we come across interesting, steady compounders, we would look at them. Now, to your question, with respect to in this market, which is so expensive, what does one need to focus on? We ran a screen last week. Of 1,200 stocks, we found 400 stocks within the universe of the top 1,200 stocks, where 400 companies are trading at 20% or more in terms of a correction that's happened with respect to
Yes.
their individual 52-week highs. So a lot of stocks have actually had a correction, and I think there are stocks within that universe that can be potentially looked at.
That's a wonderful theme that you've talked about. And amongst the three sets of stocks that have corrected fairly sharply are the defense theme. Over the
Yeah,
last 3 months, the PSU banking index is down about 6-7%, and it's the PSU metals, it's the Nifty metals index that has shed weight as well. So these
sure.
three categories, Mr. Trivedi, do they catch your attention? Are these, by the way, momentum purchases that you do, buying the dip 20-25% lower, or again, are they only in stocks that are steady compounders?
No, so my point is that if in the current environment, if somebody is looking for stocks that have corrected, these are the sectors and the
Okay.
stocks to look at. So I'm not necessarily saying come in today and start buying the market. All I'm saying is that there's enough opportunity of stocks that have had a 20% or more correction from their respective 52-week highs, and I think there are enough stocks to look at from that perspective.
Fair point. I get what you're trying to look at. Let's look at within the segment that you mentioned, special situations fund. Where would you be sort of betting on change in government policy that might trigger a sectoral move? Is it the PLI space that you're looking at? Is it something in pharma or IT that catches your attention? Where is this government change coming in?
There are two sectors specifically where the change in government policy has been hugely beneficial. One is renewables. So if you look at
Yes.
in the wind power space, for example, Suzlon and Inox Wind have outperformed uh, uh, the index over a 3 to 4 year period, and that's because the government basically has brought back the demand for wind power by saying future projects should be hybrid. They should not be only solar, because solar energy is generated only between say 8 o'clock in the morning to about 4:30 or 5 in the
Yes.
afternoon. After that, of course, the sun sets, and you don't have enough battery storage capacity at an affordable price to save that. So as a result, projects going forward are now hybrid, which is sort of a diktat from the government to all of the PSUs and also in general to the private sector, because it impacts the stability of the grid. The second, which I think is going to be also equally big and important sector, is going to be the business of data centers. We are currently just shy of 1 gigawatt of data center capacity. The government has mandated that a lot of the social media companies should be housing data of Indian citizens in India and not sitting somewhere in California or some other part of the United States. So, of course, these companies need time because there aren't enough data centers today to accommodate all of that data of Indian citizens. But over the next 3 to 4 years, I see a tripling of data center capacity. So, industries that are associated with the data center business will all stand to benefit.
These are very interesting points that you mentioned, Mr. Trivedi. Let's drill them down a little bit more. Specifically on data centers, are you looking at ancillary quasi data center plays such as real estate companies which will be physically setting up this data? Are you looking at genset makers like Cummins, which may probably provide the back-end power supply? What exactly interests you in this space?
Yeah, so there's no pure data center play per
Yes.
se. Well, there is one company called E2E Networks, but the stocks already had a crazy run. So,
Yes.
more power to them. I'm not taking anything away from them, and I wish them all the best. But the stock has appreciated so much
Yes.
that you would think maybe there's another wait for it to cool down before you buy into it. But my point really is that there are enough ancillary companies to
Yes.
play it. You're right. Real estate companies have also forayed into the data center business, either directly or via a 100% subsidiary. So we are seeing some of those names that are have done very well. I mean, Anantraj Industries is a
Yes.
great example. It's done extremely well. It's doubled this year from its lows. So as a result, I think and of course, companies that do supply onwards to the data centers space, ancillary products, all of these companies are doing extremely well.
Okay, so real estate and of course ancillaries interest you in the data centric space. Would you mind listing the total number of companies that encapsulate this booming sector? Just a number maybe?
I would think there are at least 25 to 30 companies that are sort of providing ancillary products to the data center space, whether it is the real estate itself, whether it is the uninterrupted power supply (UPS) companies that make the diesel gen sets. So there is it's a pretty big universe of products that go into a data center, and there are companies that are making individual parts of it and will benefit as a result.
Okay, that's a wonderful theme to highlight, and of course, as you say, this is how should I say, a newly minted sector, so to say, and this might have a very long run over the next couple of quarters or maybe a couple of years. Let's get back to renewables. You've mentioned two names on your own. Suzlon up 10x over the last 1 year or so. I remember it at 7 rupees, now 79. And Inox Wind has given stellar returns. The price that you see, ladies and gentlemen, on Inox Wind is after a 3:1 bonus. Do these stocks in particular or renewables theme at large still have strong legs?
Yeah, so while valuations have become expensive, I agree. The fact is there a top line growth in these companies over the next foreseeable 3 to 5 years? The answer is 100% yes.
Okay, so these are two sectors, ladies and gentlemen, which genuinely need a drill down, which is renewables and data centers, which is as a part of government change in policy, which Nepean Capital is looking into. Let's get a focus on how you see this generational shift happening within the Lal Street, Mr. Trivedi. Often when new blood is injected into an old organization or an old, how should I say, business house, a flurry of changes happen, mostly into unrelated diversification space. The new chap who comes in brings in a lot more understanding of the present world, and he tries to leverage the balance sheet of the old business house to foray into new businesses. What are the generational changes that Nepean has identified, and where is it making the maximum money?
Yeah, so here's the thing. One of the things that we look, like I said, is a generational change. But the generational change can be a positive or a negative. So there's no guarantee that the next generation may have studied overseas and come back with some bright ideas. That's great. But execution in India is a challenge. Ease of doing business, of course, has improved, but we've got a long way to go still on that. So I think, it's not always easy to say that the next generation is going to be smart and is going to do things better. There are enough cases where the next generation has not done too well or may not be interested in actually pursuing what the father has started. So, yeah, and frankly, I have empathy for both the father and the child, where you can't force, I'm just giving an example of a son or a daughter who's come back after studying overseas and has a completely different pursuit, does not want to, as an example, travel from Delhi to Faridabad and manage a factory of, 5,000 people manufacturing auto parts. So they may have different pursuits. So I personally think the important element here is what exactly is the promoter doing in that situation? Is he or she handing over the reins of the company to professionals to run and taking a step back because the children are not interested? And if that were to be the case, it's in most cases a pretty positive outcome.
Are you by any chance referring to India's largest tractor maker?
I'm not referring to anybody. I'm just saying that there are situations where increasingly where we're saying that the next generation is not interested in coming back and sitting and occupying and filling the big shoes of their parents because they don't have interest. They're lack interest in that. And frankly, if there is no interest, it's in the interest of the minority shareholders and the company to step back and actually give it on to professionals.
Absolutely, and over time we've seen that happening in America, where great amounts of fresh wealth has been created because a professional, let's just say a professional, came into the CMD driver's seat, and
That's
the
right.
owners took a back foot, and of course created more than immense wealth. That's a point well taken. The other thing, Mr. Trivedi, that I am seeing over the last 5 years or so is this increasing incidence of mergers and acquisitions by private equity players of dominant Indian corporate names, and over the last 3-4 years they've created immense wealth. Two names come to my mind: Coforge and of course JB Pharma Chemicals. When you look at this very niche segment where tons of wealth has been created, what catches your fancy?
Yeah, so I don't want to get into individual stock names. We used to own JB Chemicals in our fund number one. We don't own it anymore. But I think you did touch upon a very interesting point, and which has been a big theme for us from a special situations perspective, where global private equity funds are coming and buying out founders' stakes in listed mid-cap companies, but keeping the companies listed. And we've seen that phenomenon over the last 5 to 6 years. All the big names, Advent, KKR, Blackstone, Carlyle, etc., have been very active in that space. In fact, many times, a lot of them are bidding together, as in competing with each other to actually buy out the founder stakes. So I think that itself, for us, for a fund like ours, becomes a big trigger. The market views that change in ownership as very positive because the perception, which is mostly the reality, in at least I think 7 to 8 out of 10 cases that we've seen, where the private equity fund comes in with its best global practices, comes in with best global relationships, and i.e. opens the doors for the Indian company to do more business overseas. And lastly, I think as and where needed, they bring in a change in management, new CEO, new CFO, which also impacts the company in the long run positively. So I think we are pretty big fans of PE funds going after Indian promoters. But it ties back to my earlier point, where you see that the promoters' next generation has no interest in running the business. So what does a promoter do? He or she basically either sells the company to a private equity fund or to a strategic, or brings in professional management to run the company.
Absolutely. And they've been very, very exciting developments over the last maybe 90 or 100 months on the Lal Street, where such companies have created immense wealth. In the publicly listed sphere of your portfolio, Mr. Trivedi, if you were to break down government policy, mergers and acquisitions, and this generational change, what would be the possible number of stocks and the rough percentage that these three main entries would have?
From our portfolio, it's almost 60 to 65% of our portfolio special sits, and the balance being steady compounders.
Okay, fair point. And my last question to you: these steady compounders, Mr. Trivedi, have more or less disappointed long-term players such as us. I won't be taking names, but the top brands within the FMCG space, the leading names that we have in the private banking space, have disappointed us despite the ferocity of the rally in the Nifty and many other indices. How do you explain this dichotomy?
So FMCG is a very crowded space, and there are at least 10 to 12 very big players. I'm talking of not just MNCs but also domestic, right? So it's a function of what business you're in. And let me give you another example. You look at the EMS space. It's a new industry. 5 years ago there weren't any listed companies in India. Now we've got over 10 listed companies within the EMS space. Would you have thought of putting money in Dixon 5 years ago? Probably not. Thinking who knows what this company is going to do. It's not cheap. Today, the stock has gone to, it's been a blockbuster. If you pull it up on your screen, you'll see, for the viewers, that the stock's been a huge outperformer. But more importantly, it's now trading at 80 times FY26 PE. So it's not cheap by any standards. But even now, the stock continues to surprise, people like us who think that at some point the stock should slow down. But, I think market fascination for the company and for that industry is still immense.
Fair point. And when you come at the new IPOs space, Mr. Trivedi, more than enough froth that I have seen in the previous 4 bull runs. Somehow it, terrifies you with the kind of demand that you see on smaller SMEs. Is there a place where you hunt as a fund, or are you staying away from the IPO market?
The IPO market for any fund, my advice to them is to try and get into the anchor book. If you don't make it to the anchor book, it's, I think, a pretty fruitless exercise trying to get in any significant allocation in the QIB of the IPO, because it's so heavily oversubscribed. So we have got into a few IPOs, but it's been through the anchor book.
Oh, wonderful. So you have lots of fingers and lots of pies. And of course, all of these fingers are deep into profit. Mr. Trivedi, thank you so much for this wonderful conversation. It was such a pleasure listening to a very different approach to make markets work for you in the longer term. Let's hope the special situation funds give fabulous return over the next 24 to 36 months. Thank you for your time, sir.
Thank you.
That, ladies and gentlemen, was Mr. Gautam Trivedi. He manages 5,500 crore rupees in both the publicly and privately, publicly listed and private companies, and of course is a very, very big player in the special situation series, where you see the ownership change hands, a merger happening, change in government policy, and of course steady compounders. I hope you enjoyed the conversation as much as I did, but stay tuned to Business Today Television. There is lots happening in a market which is rallied for the 3rd day in a row and is most likely to enter into positive territory. Thank you so much for your time.
सुप्रीम कोर्ट के 75 वर्ष ये केवल एक संस्था की यात्रा नहीं है, ये यात्रा है भारत के संविधान,